Tesla stock had an okay day today, but today really didn't matter because tomorrow is the main event as far as the economy, economic data, and how investors are going to feel about markets going ahead over the next really couple of days, at least until we get the next round of economic data. Now, Friday, we have Fed Jerome Powell at Jackson Hole, and we already kind of know what to expect. We got the FOMC minutes out this afternoon at 2 p.m. Eastern Standard Time, and it's giving us a pretty good preview of what we're going to hear from Fed Jerome Powell on Friday. So without any further ado, the work is cut out for us here in this video, and we have a lot to talk about. Hit the like button as well as subscribe to the channel if you have not done so already. Ladies and gentlemen, let's start with the FOMC minutes that came out at 2 p.m. today, because we did not cover them in the last video, and just go over the most important headliners that moved markets. Now, some of this was obviously really good. It sounds good. Some of it's a little concerning from Wall Street's perspective. This post is from Liz Ann Saunders. She says, some of the July FOMC minute highlights via Bloomberg. Several officials saw a case for cutting at the July meeting. In fact, it says several participants said recent progress on inflation and increases in the unemployment rate provided a plausible case for a 25 basis point rate cut at July's meeting, or that they could have supported such a move. The quote, vast majority saw September cut as likely appropriate. And specifically, it says the vast majority of participants said it would likely be appropriate to ease policy at the next meeting if data continued to come in as expected. So really, you just need as expected data. You don't even need better than expected inflation data at this point, or, worse economic data. You kind of want to see things come in line with expectations, or the best case scenario would be inflation continuing to come down. Yes, we get another CPI report before the September 18th Fed meeting. Unless that thing is crazy high, we're going to get a rate cut coming September 18th. But also, a lot of economic data will be coming out between now and September 18th, and that's really going to decide whether or not we get a 25 or 50 basis point rate cut. If the economy holds up, 25 basis points is all we're going to get, and that's going to be seen as good enough and ultimately good news for markets. If the economy deteriorates and the markets price in a 50 basis point cut, I would be surprised if we don't fall in markets, okay? 50 basis points is probably not going to be viewed as positive unless the Fed is able to really calm markets down from any what would be bad data. The Fed also says downside risks to employment were seen as increased. Specifically, the majority of participants said risks to the employment goal had increased. Many noted risks to the inflation goal had decreased. And some Fed officials saw a higher risk of more serious labor deterioration. And finally, participants viewed the incoming data as enhancing their confidence that inflation was moving towards their 2% objective. We also did get the downwardly revised one last year job figure, and this was revised down 818,000 jobs. So really, I mean, should we even pay attention to economic data? Probably not at this point. It's so inaccurate, it's nauseating. But this was the biggest downward revision in 15 years. In fact, it was almost the largest downward revision in all of history. The only one that was bigger was during the Great Financial Crisis. Now, it's pretty interesting though. The last time we had a revision even close to as big as what we just got was back in 2019, when the first preliminary number came in at negative 501,000 jobs. 2019 was a year that some people were fearful about a recession during that time. Now, well, we just got an even worse number. And I wouldn't be surprised if it takes a couple of days for markets to kind of figure out what this means for equities. Because, I mean, is that good? Is that bad? Does that support the Fed, cutting rates faster? Like, what does this ultimately mean? Now, back in 2019, you also had the inverted yield curve, which uninverted in August. And then, I mean, we can all make an argument to whether or not that foreshadowed the Rona drop. And that's one of the more ominous things about, 2019 and the inverted yield curve is, well, you actually seen bad data as well in 2019, some pretty recessionary data. Goldman says, quote, "We think that today's downward revision to payroll growth exaggerates the degree to which job growth has been overstated. We think the true downward revision should be about 300,000 or 25,000 per month." And traders add to the Fed easing bets before jobs data, seeing 100 basis points of cuts in 2024. Now, this was before the jobs data. So you're pricing in even a little bit more than this now. This is expecting at least a 25 basis point cut September, a 50 basis point cut in November, and a 25 basis point cut in December, or vice versa. Or perhaps you get the 50 basis point cut in December and just 25 basis points September and 25 basis points in November. That's pricing in quite a great deal of either inflation continuing to decline or the economy getting worse. 10-year Treasury yields today are reflecting that, down 3 basis points following this jobs data, and almost hitting the lowest level you have seen in quite a long time. Normally, when 10-year Treasury yields have fallen to these levels, like you've seen in 2023, like you've seen on August 5th, it's usually a place where they bounce. So I wouldn't be surprised to see a little bit of a bounce in 10-year Treasury yields. But actually what's happening with Treasury yields is helping to now support a broadening out of our markets. As I reported in the last video, the RSP outpaced the S&P by anywhere from 2 to 3x today. So it was really a broad-based participation. The percent of stocks above their 50-day moving average also showed that quite well. Now with 60.3% of all stocks trading above their 50-day moving average, in fact, 3.3% of all stocks today broke above their 50-day moving average, which is a pretty good day. Especially considering the S&P 500 did a whole lot of nothing today, let's just be honest. Pretty slow day, not much of a reaction, and you actually seen almost 3.5% of all stocks break above their 50-day moving average. That in context, yeah, today was a pretty good day. But today was nothing compared to what we get tomorrow morning. Now, the next 2 days are going to be filled with what could be a lot of volatility. At 8:30 in the morning tomorrow, you get a data dump. The Chicago Fed National Activity Index is expected to come in worse than last month. I don't think markets are going to care about that. It's all about initial jobless claims. We're expecting 230,000. Some people are as high as 240,000. Last month, you came in at 227,000. Now, we could come in at 230. That's not a problem. If we come in closer to 240,000, that might be something Wall Street doesn't like. But then again, we've been higher than that in recent weeks. So I think to really get Wall Street concerned at this point, you're going to have to see a number at least come in at 240,000. At least kind of reaffirm you're still in an upwards trend of initial jobless claims going higher. Now, if we come in lower than last week again, that's going to be 4 weeks in a row. That's going to be a month in a row of declining initial jobless claims, and that would get Wall Street pretty excited, in my personal opinion. We'll see if that happens. It's a possibility. And it's also a possibility that tomorrow could be really bad based on initial jobless claims, especially considering markets have bounced a lot. Basically, all of the loss that we see in that 10% correction was poof, just gone, right? We're almost back to new all-time highs. There is a lot of room for downside if we are disappointed. Continuing jobless claims are expected to rise about 6,000. Really not a big deal. I don't think Wall Street's going to care about that too much. S&P Global Composite PMI is expected to come in a little bit better than last month. Last month, you were at 54.3. We're expecting, well, a little bit worse, actually. We're expecting 53.5. So a little bit worse on the composite headline here. Manufacturing PMIs are expected to come in line with what you've seen last month at 49.6. And S&P Global Services PMI is expected to fall 1 point from 55 down to 54. Now, really, it's about services. in regards to this data comes out at 9:45 in the morning. You're going to get a big move from initial jobless claims and then another move from your PMI data. But again, it's really about services. Services are still in expansion. Anything above 50 is expanding, whereas manufacturing's been declining essentially in a recession for over 2 years now. So if services start to roll over, that's where you can see a little bit more panic, or perhaps services come in good and maybe manufacturing goes positive again. Although that's not what we've seen suggestive in data so far, it is a possibility. Now, later on in the morning at 11 o'clock in the morning, we will get the Kansas Fed Composite Index and the Kansas Fed Manufacturing Index, expecting these numbers to be a little bit better than last month, but still come in at -10 apiece. Like, that's a really bad number, but they've been negative for a long time anyway, so it's not going to be a big shocker. At 10 o'clock in the morning as well, I almost skipped over this, existing home sales will come out for July, and existing home sales month over month. So you can see how today's data was really not that important relative to initial jobless claims. You know, the data we got today really didn't, I guess, tell us too much. It didn't change anything. You know, in the grand scope of things, no jobs were added or lost yesterday, right? Or it's kind of just the same old. And I think that's why markets didn't react to it too much initially when that revision came out today. But I do think it's possible we could get a multi-day kind of maybe negative impact on markets. But that's still, you know, to be determined. Tomorrow is going to be important with initial jobless claims because that's more real-time information on what the economy is doing. Now, in specific regards to Tesla, as I have said many times, if the economy does well, Tesla will do well. If the economy does poorly, Tesla will do poorly. It really doesn't matter about the Fed, you know, cutting rates at this point. The only way rate cuts are going to be a positive for Tesla is if the Fed's cutting rates because the economy is doing okay and inflation is falling. Now, with that said, Tesla stock closed above $220 per share. That's great. Okay. That means we're still game on for a much larger potential rally, and the catalyst for that rally could come tomorrow as long as initial jobless claims do not come in higher than expected. And I think heading into October 10th, you could see quite a big rally for Tesla. Morgan Stanley puts Tesla stock in their North American top picks list. And this comes after the last 2 days or so, Piper Sandler's analyst Alexander Potter has suggested or recommended, if you will, owning Tesla stock into the Robotaxi event on October 10th. And again, Tesla stock has rallied back quite a bit from the 180s to the 220s. But there's still a lot more room for Tesla to run if we really do get more indications of a soft landing and the Fed that is about to start cutting rates. That is the best case scenario for Tesla. Soft landing and Fed rate cuts are going to equal great things for Tesla stock investors. And then obviously, not to skip over the obvious here, we have Fed Jerome Powell Friday at about 10 o'clock in the morning. He speaks at Jackson Hole. But again, I think it's so televised what the Fed is going to say that it may already be priced in. And I will also just point out the VIX, the Volatility Index, was up about 4% today, which does show a little bit of concern heading into tomorrow. And I think it's kind of snitching, if you will. Tomorrow is going to be a pretty important day for markets. My personal opinion, though, let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.